All right, our top story tonight. Talk about some serious economic mood swings. Some big data points coming in today. The Consumer Confidence Index shot up in April. Home prices soared to the highest level in 7 years. But at the same time, the Chicago PMI, which is a key indicator of business activity, fell to contraction levels for the first time in more than 3 years. So what should you believe? Our Money Power panel is here to break it all down. Peter Schiff is the CEO of Euro Pacific Capital. Matthew Tuttle is the CEO of Tuttle Wealth Management. And Jonas Max Ferris is co-founder of MaxFunds.com. Thanks to all of you for joining us. Peter, let me start with you. That consumer confidence number, very positive. Does it make you feel good?
Well, sometimes confidence is not a good thing. You know, if you're skating on thin ice, but you're confident that it's thick, you can get into a lot of trouble. I think rising home prices are creating the false impression that things are getting better, but actually rising home prices is more of the problem. I think the PMI was more indicative of what's really going on. In fact, I think the real economic situation is a lot worse than even the PMI would suggest.
Peter, I feel like I knew you were going to say that. Matthew, do you think that those rising home prices are a sign of something bad as opposed to something good?
No, I look at it as a sign of something good. I mean, the consumer number, the home price number, they all came with some buts, but things are still going in the right direction. And, you know, I think we've now got an economy that's not too hot, not too cold, which means the Fed's probably going to keep their foot on the gas, which is going to be good for stocks.
Jonas, I mean, isn't that the secret right now, is that sort of Goldilocks type situation where we want it not too hot because you don't want the Fed to get out of the game, but not too cold, obviously, because that's no good.
Yeah, it's hard to describe it as a Goldilocks situation. The economy is really not the best of any worlds. But
you're not going to help me out here at all.
No, that is the big scare. They're going to stop subsidizing money, basically, and giving it away. And the economy just isn't strong enough to stop it. And there's so little inflation that deflation is still a fear. And that's a horrible thing, which is why I think the home thing is important, because if that price wasn't going up with the rates that we have now, it basically would be disguising a depression. And since we're not, because they are going up with these lows, which is good, people are buying homes, even investors are buying homes.
They're buying homes they can't afford.
Well,
With money, look, Jonas, that's the problem. It's the only reason that real estate prices are rising is because people are taking advantage of low rates. There's a lot of speculators now buying. There's a lot of private equity money that's trying to flip single-family homes. I mean, this is how we got into trouble. Eventually, rates are going to go up. Look at the dollar index today, hit a 10-week low. If that dollar really starts to come under pressure, that's going to put a lot of pressure on the Fed.
Because if you look at the people that are in there in the housing market, it is still very difficult to get a loan unless you put a significant amount down. When you talk about private equity, yeah, it is. I mean, if you go out, I mean, unless you're getting an FHA loan, Peter, you're getting 3%. That's a small part of the market.
Who's trying to buy as an investor in real estate, all the bids are getting bought by all cash buyers. So it's not like this mortgage-fueled, debt-laden market anymore. These are cash buyers.
Those all cash buyers are borrowing money. These are private equity funds that are paying all cash.
So
believe me, they are levered up too. You don't see it in the transaction. It's behind the scenes.
But that's, I mean, that's
when you see cheap money from the Fed.
But you're acting like they're buying an overvalued asset that's like up 300% in the last 3 years, like in Miami or Vegas. These homes are still down 40%. When you adjust for the interest rates, they're down 50% nationally, but even in some markets. So it's cheaper than renting in many cases. And if you factor in any kind of inflation, which I think you are.
When interest rates go up, it's a whole new ball game, you know, and we still have a lot of people who are unemployed.
I think we've got some room to go.
There's lots of empty houses that no one's living in. There's a backup in the foreclosures.
Hang on, guys, we got to go one at a time, and let me let I love the argument, but let me let Matthew back in there for a second. What do you think of this dispute? Which side do you come down on?
Well, I come down on the side that, you know, in the future, who knows what's going to happen with this. But for right now, this is good. For right now, the consumer is making money on their house. The consumer's got confidence. They're making money in their 401k. And it argues that we should be buying stocks, but you've got to be tactical with it.
Just like 2004, just like 2005,
sure,
all over again.
But
Isn't that great? Right?
But
We're setting ourselves up for a bigger disaster.
Peter, let me ask you, hang on one second. Peter, let me ask you, private equity is coming back into the market with all cash in order to buy homes. In a lot of cases, they're buying them to rent them out. What is wrong with that? Isn't that a traditional bottom in the market when you see, I mean, that's a classic arbitrage play. They see an opportunity, so they're coming in with cash.
No, I don't know that it's a bottom. I think they may think they're buying the bottom, but they're catching a falling knife, I think, in the real estate market. But they are borrowing money. But what's happening is they have cheap financing. They're trying to rent out single-family homes, which is very difficult to do. I mean,